What actually drives the valuation of a brand as it expands nationally? Why do some franchise brands explode in value while others plateau? Because here's the reality that most entrepreneurs don't understand. Valuation is not about how much revenue a business makes today. It's about how predictable, scalable, and defensible that revenue will be tomorrow. I'm Justin Kaiser, co-founder and CEO of Empire Franchising. And for the past 24 years, I've been building businesses, structuring equity deals, and helping entrepreneurs turn companies into scalable platforms, including scaling my own franchise brand from 0 to over 100 franchise territories before an acquisition. And what I've learned is that when a brand begins expanding nationally, the conversation shifts. You're no longer just building a business, you're building an asset class. And the way investors, private equity firms, and institutional capital look at that asset class is very different than how most founders think about their company. Because valuation is not emotional, it's mathematical, it's structural, and it's strategic. Let me explain. When a brand is local, valuation tends to be based primarily on EBITDA, maybe 2 times, 3 times. If you're lucky, maybe 4 times. But the moment a brand proves it can scale through franchising, the valuation model begins to change. And the reason is simple. Franchising transforms a single operating business into a distribution platform, and platforms command higher multiples because they have leverage built into the model. Every new franchise location adds revenue without requiring the parent company to build, staff, and operate the location. Instead, the franchisor earns royalties, franchise fees, vendor rebates, marketing fund contributions, and other system economics. That means the marginal cost of expansion is dramatically lower than a traditional company, which means profitability scales faster, and scalability is what drives valuation. But scalability alone is not enough, because investors are not simply looking for growth. They're looking for predictable growth, predictable systems, predictable unit economics, predictable franchisee success. Because predictability reduces risk. And risk is the single biggest variable in valuation. Think about it this way. If a brand can prove that every new franchise location has a high probability of success, then each additional territory becomes a predictable future revenue stream. And predictable revenue streams can be valued years in advance. This is where national expansion changes everything. Because once a brand demonstrates that its model works across multiple markets, different demographics, different operators, different geographies, it becomes clear that the business is not dependent on a single founder or a single location. It's dependent on a system. And systems are what investors buy. This is why some franchise brands that aren't highly profitable still command massive valuations. Because investors are not buying the present, they're buying the future system. Now, there's several core drivers that determine how valuable that system becomes. The first driver is unit economics. If a franchise location can't produce strong returns for franchisees, the entire system eventually fails because franchise sales slow down, referrals disappear, and the brand loses the momentum. But when unit economics are strong, franchisees reinvest. They open additional territories. They become brand evangelists, and suddenly expansion accelerates organically, which dramatically increases enterprise value. The second driver is territory scalability. A brand that can operate in the hundreds or even thousands of potential markets has a fundamentally different valuation profile than a brand limited to niche geography. Investors love total addressable market because it defines the runway for growth. If a concept can scale across the United States and potentially internationally, the ceiling on valuation rises dramatically. The third driver is system infrastructure, and this is where most brands struggle because scaling nationally requires far more than selling franchises. It requires systems, onboarding, training, technology, marketing engines, operational playbooks, franchise support structures, compliance frameworks, and leadership that understands platform building. Without infrastructure, growth becomes chaotic, franchisees struggle, and the brand becomes fragile. But when infrastructure exists, expansion becomes repeatable, and repeatable systems are extremely valuable. The fourth driver is brand defensibility, because investors want to know that the brand has some form of competitive advantage. Maybe it's proprietary systems, maybe it's unique supply chain advantages, maybe it's intellectual property, maybe it's a powerful brand identity, maybe it's operational know-how that competitors can't easily replicate. Whatever the moat is, it increases confidence that the brand will maintain market position as it scales. The fifth driver is franchisee alignment. And this is something that most founders underestimate because a franchise system is essentially an economic ecosystem. The franchisor, the franchisees, the vendors, the support team, the marketing infrastructure, everyone must be aligned economically. If franchisees win, the system grows. If franchisees struggle, the system collapses. The sixth driver is leadership vision, because ultimately, a national brand requires leadership that understands platform strategy, not just day-to-day operations. Platform builders think about infrastructure, capital strategy, long-term brand positioning, technology integration, and expansion strategy. They're not simply operating a company, they're designing a stable ecosystem. Now, when all of these elements come together, something powerful happens. The business becomes a platform, and platforms command dramatically higher valuations because platforms create leverage across geography, leverage across operators, leverage across capital, leverage across time. This is why private equity loves franchise platforms, because once a brand has strong unit economics, scalable infrastructure, and a proven expansion model, capital can accelerate growth rapidly. Territories can be developed, marketing can be amplified, leadership teams can be expanded, and suddenly a brand that once operated in one city can expand to hundreds of locations across the country. That's transformation from local operator to a national platform. And this is what creates extraordinary enterprise value, and it's exactly the philosophy behind what we're building at Empire Franchising. We don't just look at businesses as they exist today. We evaluate whether they have the DNA to become scalable platforms. Because when a concept has the right economics, the right infrastructure, the right leadership, and the right market opportunity, franchising becomes one of the most powerful growth engines in business. And more importantly, one of the most powerful wealth creation engines for founders and investors. So if you're a founder building a brand or an investor evaluating opportunities, start looking beyond revenue. Start asking deeper questions. Are the unit economics strong? Is the system scalable? Is the infrastructure built to support national growth? Is there a defensible brand moat? Is the leadership thinking like a platform builder? Because those are the factors that truly drive valuation as a brand expands nationally. Not just revenue, not just growth, but scalable, predictable, repeatable systems. If you want to learn more about how we evaluate franchise brands, structure franchise platforms, and help entrepreneurs scale nationally, then visit empirefranchising.com. And if you found this information valuable, subscribe to the channel, because I'm going to keep unpacking strategies, frameworks, and lessons behind building scalable businesses and investment-grade platforms.